Every dealership has one. The car in the back row that looked perfect when it arrived, but somehow survived 3 sales events, 2 price cuts, and the arrival of the next model year. Dust gathers around the tires. The online listing gets new photographs. The price changes again, and still nobody buys it. So what happens next? Does the manufacturer take it back? Does it become used even if nobody owned it? Is it shipped to another country, dumped at auction, or abandoned in one of those enormous fields of supposedly unwanted cars? The real answer is less dramatic and more interesting. An unsold car moves through a financial system designed to make standing still increasingly uncomfortable. In December 2025, Cox Automotive estimated roughly 3 million new vehicles were available in the United States, equal to about a 90-day supply at the recent sales pace. NADA's dealership productivity guide uses 45 days as a benchmark for new inventory. That gap matters because a car on a lot is not scenery. It is borrowed money, shrinking market value, occupied space, and a sales opportunity that has not happened yet. The longer it waits, the more the system changes around it. Most dealers do not write a check for every vehicle parked outside. They use inventory credit called floorplan financing. A lender, often the manufacturer's finance company or a bank, advances money against specific vehicles. The cars are collateral. When one sells, the dealer generally repays the associated balance within a few business days. This transforms time into a visible expense. Imagine a vehicle financed at $50,000 with a 6.2% annual interest rate, similar to a rate disclosed by one public dealership group for 2025. Gross interest is about $258 per month. After 90 days, that is roughly $775 before considering any manufacturer assistance. Interest is only the first layer. The car needs insurance, cleaning, battery maintenance, advertising, lot space, and employee attention. It can be damaged by weather or test drives. More importantly, $50,000 of borrowing capacity is trapped in a model customers keep walking past. Manufacturers may provide floor plan assistance, holdback, advertising support, or incentives that reduce some carrying cost. But the support is not an endless free parking permit. Once the vehicle ages beyond the assumptions built into those programs, time begins pressing directly on the dealer's margin. The first destination of an unsold car is usually not another lot. It is a lower number on the listing. Dealers watch inventory by age. A vehicle may enter a 30-day, 60-day, or 90-day bucket. The exact thresholds vary, but the logic is consistent. A fresh unit can wait for a strong retail deal. An old unit must justify why it is still using capital. The price cut can come from several places. The dealer can surrender some gross profit. The manufacturer can offer customer cash, subsidized financing, lease support, or a dealer incentive. Sometimes both sides contribute. Public dealership filings describe manufacturer programs that become especially important when supply is excessive or sales are flat. Suppose a vehicle might have produced $3,000 of front-end gross profit when fresh. After months of interest, advertising, and a new model year arrival, the dealer may accept $500, or even a small accounting loss, to free the floor plan line and make room for a faster seller. That does not automatically make the deal unprofitable. Financing, warranties, accessories, trade-ins, service relationships, and manufacturer targets can affect the full transaction. But the aging car has changed the negotiation. The dealer is no longer protecting the original dream. It is comparing the cost of selling today with the cost of waiting another month. One of the biggest misconceptions is that an unsold 2025 model becomes a used car when the calendar reaches 2026. It does not simply expire at midnight. Newness is tied to ownership, registration, title, mileage, in-service use, and local rules, not just the year printed on the window sticker. A never-retail sold vehicle can remain new inventory while newer model years sit beside it. That is why dealerships can advertise a new car from the previous model year. Economically, however, it is older. Buyers compare it with the updated model, and lenders or valuation systems may treat the model year differently. If the newer version has better technology, a redesign, or a similar price, the older car needs a reason to exist. Usually that reason is a discount. Warranty timing also deserves attention. Coverage often begins when the vehicle is first placed in service, but demonstration or loaner use can affect dates and mileage. Rules and manufacturer policies vary. A buyer should ask for the in-service date, current mileage, warranty balance, damage history, and written out-the-door price. So the label can remain new while the economics become increasingly similar to aged merchandise. The car has not crossed a legal magic line. It has crossed a competitive one. Sometimes the problem is not the vehicle. It is the location. A four-wheel drive truck may sit in one market and sell immediately in another. A specific color, trim, engine, or seating configuration may be unpopular at one dealership but match a customer order somewhere else. Dealers within the same brand can trade inventory, exchange vehicles, or arrange transfers. This is one reason online listings sometimes show a vehicle available even though it is physically at another store. The receiving dealer may already have a buyer, while the sending dealer wants to replace an aging unit with something better, suited to its local demand. The economics are straightforward. Compare another month of interest and a larger future discount with the transport cost and transaction terms of moving the car now. If a $600 transfer prevents a $2,000 markdown, movement creates value. Dealer groups can make this process easier because several stores share data. They can see that a model is aging in one city while selling quickly in another. Independent dealerships rely more on phone calls, brand networks, and wholesale relationships. The car has not failed. The original allocation did. Inventory transfer is the market correcting a forecasting mistake one vehicle at a time. If a car is not attracting a retail buyer, the dealership may put it to work. It can become a demonstrator driven by staff or used for customer test drives. It can enter a service loaner fleet, giving customers transportation while their cars are repaired. Some stores use vehicles for executive transportation, local events, or short-term rental programs. The Federal Trade Commission describes demonstrators as new cars that have not been owned, leased, or used as rentals, but have been driven by dealership staff. That definition shows why mileage alone does not tell the whole story. A demo can still be untitled inventory, yet it is not equivalent to a factory-fresh car with 12 miles. This route converts idle inventory into a business asset. A loaner supports the profitable service department, introduces customers to newer models, and may earn manufacturer support. But use also adds mileage, wear, depreciation, and an in-service date. Eventually, the vehicle is retired from the program and sold with disclosure appropriate to its status. For the dealer, the equation changes from how much can this new car earn in one sale to what service value can it provide before we sell it. For the buyer, the opportunity is a lower price, but only after verifying mileage, warranty, maintenance, previous damage, and how the vehicle was used. Wholesale auctions are a major exit for used cars that do not fit a dealer's retail strategy. Public dealership filings explicitly say used inventory that fails to sell at retail is commonly sent to wholesale auctions. Brand new vehicles are different. Franchise agreements, manufacturer programs, title status, and the risk of disrupting retail pricing make auction a less attractive first choice. A dealer would usually prefer a retail discount, another franchise dealer, a fleet buyer, or productive demo used before accepting a wholesale result. But wholesale channels can eventually appear. A vehicle may be titled into a loaner or rental fleet, accumulated with mileage and later sold as used. A dealer closing or losing a franchise may have inventory redistributed, repurchased under applicable agreements, or liquidated. Damaged vehicles can enter specialized channels with proper disclosure. At auction, the price becomes brutally current. There is no emotional attachment to the original sticker. Professional buyers compare mileage, condition, history, local demand, transport cost, and the margin they might make on resale. This is the final lesson of wholesale. Inventory always has a buyer at some price. The question is whether that price pays the previous owner's costs. Never sold usually means not sold yet at the price somebody wanted, not worthless. Dealers are not the only ones responding. Unsold inventory sends information back through the entire production chain. When day supply rises, manufacturers can increase rebates, subsidize interest rates, support leases, slow factory output, cancel shifts, or change future allocations. They may encourage dealers to move certain configurations and reduce production of unpopular versions. This response is slower than changing a website price because factories, suppliers, shipping schedules, and labor plans were arranged months earlier. That delay explains overflow storage. Photographs of huge parking areas often show vehicles waiting in normal logistics, import processing, quality holds, seasonal inventory, or temporary excess supply. A full storage lot can signal imbalance, but it is not proof that every vehicle has been permanently abandoned. The industry measures inventory in days of supply, available units divided by the recent daily sales pace. It is a moving ratio. Inventory can remain unchanged while days supply rises because sales slow, or the number of cars can increase while days supply falls because buyers accelerate. Manufacturers would rather reduce output than build cars forever with no buyers. The lot is a buffer between a complex factory system and unpredictable consumer demand. When the buffer becomes too large, incentives rise and production eventually moves down. Consider a simplified $50,000 vehicle. At arrival, the dealership hopes for a normal retail margin. During the first month, manufacturer assistance may cover much of the financing cost. By day 45, the car has crossed a common inventory benchmark. By day 90, gross floor plan interest at 6.2% approaches $800. Advertising and maintenance continue. Then the next model year arrives. The dealer adds a $2,000 discount. Another month passes. Now a $3,000 incentive may be available, but competing dealers receive similar support, so market prices move down together. Waiting no longer protects the sticker price. At day 120, the important figure is not the accounting profit already lost. That is sunk. The decision is forward-looking. What is the expected net result from selling now, transferring the car, using it as a loaner, or holding it another 30 days. This is why aged inventory meetings can be ruthless. Every vehicle has a stock number, acquisition date, floor plan balance, online activity, test drive history, competing listings, and estimated exit value. The oldest car is not automatically the worst car. It is simply the car whose original forecast has had the most time to be proven wrong. For buyers, aged inventory can create leverage, but a discount is not automatically value. Start with the vehicle identification number and build date. Compare the older model with the current one. A $5,000 discount is less attractive if the new version includes equipment you would otherwise add, better safety technology, a major battery improvement, or stronger resale value. Then ask why the car remained. An unpopular color may not matter to you. A rare configuration could be perfect. But a history of repaired shipping damage, repeated warning lights, extensive demo use, or a long open recall changes the calculation. Get representations in writing and inspect the vehicle carefully. Confirm every incentive. The FTC warns that advertised discounts may depend on financing choices, military status, recent graduate status, current leases, or other conditions. Ask for an itemized out-the-door price before visiting. Separate the vehicle price from the trade-in and the financing discussion. Finally, verify warranty start date, tire and battery condition, mileage, software updates, and whether the car was placed in service. Time affects machines even when they are not driven much. The opportunity exists because the dealer's cost of waiting may now be larger than your cost of negotiating. Your advantage comes from understanding that clock. Most unsold cars eventually reach ordinary buyers. A much smaller number follow unusual paths. A dealership closure can trigger lender audits, inventory transfers, manufacturer repurchase obligations, or liquidation. A vehicle damaged by hail, flood, transport, vandalism, or fire may be repaired and disclosed, sold through a specialized auction, claimed through insurance, or dismantled if repair is uneconomic. A quality hold can keep cars parked until a software or hardware issue is corrected. Some vehicles are sold in fleet batches to rental companies, governments, or businesses. Some move across borders when regulations, specifications, and economics allow. Others become training vehicles, company vehicles, or parts development assets. Scrapping a complete new car is possible, but it is a last resort outcome, not the normal destination for slow inventory. Even a deeply unpopular car contains recoverable value in its powertrain, electronics, body panels, and materials. Destroying it usually produces less than discounting it into a willing market. The famous car graveyard explanation skips every incentive in between. Dealers want their credit line back. Lenders want repayment. Manufacturers want market share without destroying brand value. Buyers respond to lower prices. Those forces keep pushing the vehicle toward a transaction long before abandonment becomes rational. So what happens to cars that never sell? First, never usually means not yet. The listing price changes. Manufacturer support increases. The vehicle moves to another dealership, becomes a demo or service loaner, enters a fleet, or eventually reaches a wholesale channel. Meanwhile, the manufacturer reads the buildup and adjusts incentives, allocation, and production. The car may remain legally new while becoming economically old. That distinction is the entire story. The metal does not suddenly change. The title may not change, but the cost of carrying it rises, the next model year changes the comparison, and the dealer's willingness to wait collapses. In 2025, America's franchise dealers sold more than 16 million new light vehicles. That enormous machine works because inventory is constantly repriced and redistributed. The visible car lot is only one frame in a network of lenders, factories, transporters, auctions, service departments, and buyers. An unsold car is not waiting outside the market. It is inside the market, generating signals every day. Interest says move it. Depreciation says move it. New production says move it. And eventually, a lower price finds someone whose answer changes from no to yes. Cars do not disappear when they fail to sell. Their margin disappears first.